Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Hello, and welcome to Macro Minutes, the European edition. We are recording today on the 10th of March 2026, and my name is Cathal Kennedy. I shall be your host today. I'm joined by Peter Schaffrik and George Moran. Now, of course, we need to discuss the impact of the conflict in the Middle East on the European economy, and specifically whether the 2022 outcome is a blueprint to follow. Or to put that another way, is this deja vu all over again? So, Peter, let's start with you, and a very warm welcome back to 2022.
Yeah, thank you, Cathal. Well, I guess you gave me free rein here, so let me maybe talk you through my thoughts of what is similar and what is quite different to 22. So obviously, we have some kind of a conflict that's similar. We have a significant spike in oil and gas prices. That's similar, although the magnitude is different. It isn't as severe yet as it was in 22. But I think for us in Europe, there is a key difference, and I would like to highlight that. So in 22, we were faced almost with a double dilemma. One dilemma was prices were going up, and we're net importers, so the European Union imports on average about 350 billion of oil and gas per year. And that means if prices are going up, the bill goes up, and it's a negative terms of trade shock. So that's clearly negative, and that's happening again. However, the second dilemma that we faced in 2022 was the question about availability of gas and oil, because we were quite reliant on Russia. Just some figures to bring it to life, so to speak. In 22, about 25% of our oil came from Russia. Now about 12% come out of the Middle East. So even that's still disrupted. The share is smaller. And when we talk about gas, which is also an input into electricity prices, of course, the difference is even starker, because back in 22, 60% of the gas that's been delivered through pipelines came from Russia. And today, nothing comes through pipeline in the gaseous form, because there is no pipeline going to the Middle East. So most of our, or all of our gas that's been delivered through pipelines, which is about half of the gas that we're receiving, should be safe. Also, when we look at LNG, back in 22, still a decent amount came from Russia. Now, about 6% of all LNG, which is about 3% of our total gas imports, come from the Middle East, and the lion's share is coming from the US, which should be quite safe. So what I would say is that for us over here in Europe, the price impact is very important. We can talk about the economic impacts in a second, but there should not be a threat of shortages in either oil or gas, and that's obviously quite important. But if I may say, other parts of the world, sadly, face very similar situation as we had in 22, and do face that threat of a shortage, which is predominantly Asia, and of course, that has a cross-feed into us as well. But so I'll probably leave it there for the first question, but in my mind, those are the key similarities and differences.
Okay, so if I'm hearing you there correctly, Peter, then we in Europe are not facing the same acute supply issues as we were in 2022. But we're still facing a significant energy price shock from this, are we not? George, maybe this might be a good opportunity for you to come in, perhaps give us your thoughts on the inflation impacts of this?
So, Cathal, just to build on what Peter's saying, energy prices can work through several channels when they hit the economy. One of the soonest impacts we're likely to see is a big increase in fuel prices. It's almost immediate, this impact. It probably takes a couple of weeks for oil prices to feed through into fuel prices. And fuel prices have a very close correlation to the first futures contract for oil, which has gone up by a lot so far. It's not really clear yet where this is going to settle for March, because oil prices are very much in flux at the moment. But it certainly looks like there's going to be a big positive impact. For inflation further out, the impact really depends on if this is persistent or not. If oil prices stay high for a prolonged period of time, inflation will remain high for basically a whole year until we get potentially negative base effects in 2026. If oil prices shoot back down, which seems a little bit unlikely given turmoil is likely to continue for the time being in Iran, we would see those inflation effects unwind fairly quickly. But really, it all depends at this point what happens to oil prices. Now, if we think about energy prices more broadly, just beyond oil, Electricity prices largely are determined by natural gas prices. Now, natural gas prices have been rising, but we're far, far from where we were in 2022. So we really need to see a much bigger increase in natural gas prices for that really to start hitting consumers, household and business energy bills. Another point worth making, just to add on to what Peter said, is if you're going to have an energy crisis, then this is probably one of the better times to have it during the year. We're heading out of one of the coolest season, and we're heading to a point in the year where usually we'd be rebuilding our gas storage. So perhaps we can take the opportunity to not rebuild at the same pace and consume some of that gas instead. So I'm not as concerned at the moment about electricity prices and prices more broadly because of that element. And also another point worth noting is that a lot of gas bills actually are not gas. A lot of it is made up of network fees, taxes. So the transmission from natural gas to retail prices is very much not one-to-one. And finally, another point just to make, which is really crucial for central banks, is whether this will impact inflation more broadly as well. And we're really watching inflation expectations super closely because the big risk is that households start to think that inflation is going to be higher for a longer period of time, and they start going to their employers and they start asking for pay rises. And that's really the mistake the ECB made back in 2022, is they took their eye off the ball a little bit from inflation expectations, and that led to services inflation getting out of hand and led to quite a persistent inflation overshoot. So inflation expectations will be crucial to watch to see if this inflation impact will be more broad-based.
If I could quickly interject here, one of the other points to make, going back to what I said at the beginning about the conflict, is when you look at the forward curve for oil and gas prices, what you're seeing is that the more forward-looking the prices are much lower than like the first contract or the second contract. So what the market seems to be implying is that in a couple of months' time, we've got much lower prices again, which in my mind is plausible if the conflict ends soon. But one of the things to consider is the longer the conflict lasts, the more likely it is also that those more forward-looking prices go up. And that's then feeding through more closely, as George was just explaining, into other parts of the economy as well. So it's clear that the duration of the conflict and actually the damage to the infrastructure that's being done in the meantime, and that will determine how long it will take to restart any potential deliveries and production of oil and gas in the region. It's also very key to those input factors that George was just talking about.
Yeah, Peter, that was just something I was going to kind of try and ask George to elaborate on a little bit. That sort of how this feeds through to kind of the real economy, if you will, because what you guys are saying is essentially, we don't face the same risk as in 2022 in terms of being able to keep the lights on. We're not facing kind of a situation where we have to ration energy, but we are facing a price shock. Okay, not on the same scale, but still a kind of price shock from this. Kind of, George, you were sort of beginning to kind of talk about sort of how that might feed through. Can you just kind of elaborate on that a little bit for us?
Yeah, so I think it's worth setting the scene before we start about where we were before the Iran crisis occurred. Now, in a way, we were stronger than 2022 in some ways, but weaker in many other ways as well. So we were actually pretty constructive about growth before the Iran conflict began. It's probably not a game changer at the moment, the Iran conflict, but that's very much up in the air, as we discussed. But going into this crisis, we had an upswing in GDP within our forecasts. We expected fiscal policy in Germany to be very stimulative to the economy, to hit the economy faster than people expected, and in a quite a front-loaded manner. And we had early evidence suggesting that would be happening. So military orders have been very high in Germany so far. The budget numbers are showing a large amount of spending is already being allocated to the military and to infrastructure. So we were pretty positive on this. GDP data and the survey data was looking pretty good going into the start of 2026. We've had more evidence that consumers have been starting to spend down their savings a little bit, which has been boosting consumption. That's probably been one of the large reasons why GDP has been held back in the euro area for several years. And it also looked like the construction sector, which had been very weak, had been hurt by ECB rate hikes, was finally starting to recover. So the base is not super weak going into this, but if we look at other aspects like the labour market, it does look like we're not as tight as we were in 2022. Vacancies are down much lower than they were in 2022 when we were having an energy price shock at a time for peak vacancies. So firms were really struggling to hire back in 2022. That's not so much the case at the moment. I think just stepping back a little bit, and we've had quite a lot of conversations about how an oil shock now compares to shocks, but in 2022, but also going back further as well. Generally, the euro area, over the space of its history, has become a lot less oil dependent. And this has been a more global trend that we've seen. GDP has outstripped oil consumption by some multiples over the last 25 years or so. And that means generally economies across the world are less exposed to oil. If we look at certain countries in the euro area like Spain, they've had a massive transformation in terms of how they've been able to produce energy. Spain is now the go-to place in the euro area to build data centers because energy costs are so low there. Some countries are more vulnerable. Italy's a bit more vulnerable, has a high natural gas exposure. Germany has a high natural gas exposure. But I think the exposure in 2026 is very different from the exposure if we look back to, say, the last Iran oil crisis in 1979.
So if I try to sum up what you said there, perhaps we can overdo the impact of this a little bit. But I think that kind of context for me of this price shock, if you will, even if it's more moderate than was previously, hitting against a weaker labour market. Perhaps I'm looking through it from the prism of the UK a little bit here, but that's not a scenario which central banks find it easy to respond to. How do we think the ECB's reaction function will be affected by this? Or is it too early to say?
So first of all, I think it's too early to say, and I'm conscious that we're recording this and ahead of the ECB meeting next week. So I don't think anything is going to happen there. They will probably flag out that there are some risks, but certainly nothing is going to happen. And I think you raise a key point, and the things that George just mentioned sort of also raise very distinct questions. So when we think about, even if we assume for a second that the oil price shock is maybe longer lasting, maybe even if we assume that prices increase even further from here, there's another big question mark when we compare to 2022 is how does it transmit ultimately into the economy? Because back in 22, and I remember distinctly that we were making that point that this would likely happen, is we came out of the pandemic, our job opening rates were very high, demand for labor was very strong, and there was still stimulus being paid in the US and in other places to support people and their consumption. We had overconsumed goods during the pandemic and underconsumed services, and people were desperate to go back out and consume services as well. So it was always quite likely, in our view back then, that corporates were quite able to pass on any price increases to consumers. And this is exactly what has happened. And as a consequence, then, hardly anyone lost their jobs because corporates were not enacting job cuts. And as a consequence, therefore, the economies, even though they obviously took some kind of hit through the price increases in oil and energy, were not outright descending into a recession. Now, fast forward to today, corporate margins are probably weaker now. The job market, as George was just alluding to, certainly is weaker now as well. And there's not any major stimulus being paid out at the moment. So it stands to reason that if we had a not even similar price shock to 2022, but at least a pronounced and prolonged one, whether or not this time round price increases could be passed on, or if corporates would had to take margin cuts and ultimately would enact cost-saving measures. And if that's the case, then I think our labor markets are much more vulnerable now than they were in 22. And that, of course, ultimately would also have ramifications then for economic activity and ultimately also for policy rate setting. Now, I'm not saying that I have the magic solution or the magic answer to that question, but it's certainly something that we are considering and pondering when we think about that. So it's not as clear cut that it's really a 2022 déjà vu, to sort of use the title of this recording. But actually, Cathal, if you don't mind, I mean, you just mentioned that you're looking through this, or you came to that question by looking through the lens of the UK. So if I turn the tables a bit, we've been mainly reflecting on the euro area or the EU more broadly. But how does that all impact the UK? Does it change your outlook for, let's say, the Bank of England, for instance?
I think I think in terms of what you guys were saying there about the euro area and the impacts and how it feeds through, I mean, it's very similar for the UK. The immediate impact will be felt via fuel prices at the pumps. That's where the increase in oil prices will show up. First, it takes 2 to 3 weeks, I think, for it to come through. And it'll hit, assuming sort of the move in gas price lasts, it'll hit domestic utility bills with a bit of a lag because of how the off-gem price cap works. So the households won't feel any sort of impact until July. But I think kind of from the perspective of the MPC, I think what it does is it undoes a lot of the good story they were able to tell in February about sort of the risks to inflation. And a big part of that good story, if you like, from February was that inflation falls quite sharply in April because of announcements the government made at the budget last November, mainly on energy bills. And what you're seeing at the moment kind of undoes a lot of that. So the bank's thinking was that, well, inflation normalises, that'll help normalise inflation expectations going forward, and then in turn that will help normalise wage demands. Well, if inflation is being held up, if you like, to kind of by energy prices, that feed-through story isn't there. So I think the bank will be cautious. Let's face it, they were cautious cutters to this point. They'll continue to be kind of cautious. Certainly in the near term, again, we have a Bank of England meeting next week. I think it's taken the idea that the bank cuts at this meeting off the table completely. I mean, the February meeting seemed to set up this coming meeting for a further rate cut from the bank. But I really can't see that happening given this backdrop. Much better to wait and see, play for a bit more information and try and kind of plug that into your forecast come the April meeting. That answer your question, Peter?
Yeah, it certainly does. Thank you.
Well, with that, I'd like to thank you all for listening to this edition of Macro Minutes. We sincerely hope you've enjoyed this and have learned something from listening to Peter and to George, and we look forward to speaking to you again soon.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.